We are breaking down the latest moves for PayPal today, and you really need to pay close attention because the surface numbers are completely lying to you.
Oh, absolutely. They're very deceiving right now.
Right. Like, if you pull up the stock right now, it's trading at $56.07. It's basically flat, down just 0.14% on the day.
Barely moving.
Yeah, and a lot of noise in the broader market might make you think, nothing is happening here. But that flat movement is masking this massive underlying story.
There is an incredible amount of tension building under that $56 price tag. I mean, it's coiled tight.
It really is, because the major catalyst driving all the big money's attention right now is this huge unconfirmed M&A rumor. Word on the street is that Stripe, partnering up with Advent, is circling to buy out PayPal.
Right.
But the real kicker, the part that should make anyone following this space sit up and take notice, is that PayPal's board reportedly already rejected an offer of $60.50 per share.
Wow.
Yeah. They didn't just turn it down, they called it flat out inadequate.
Think about the audacity of that for a second. I mean, your stock is sitting at $56, right? You have competitors eating into your market share. The macro environment is brutal. And you just slap away a premium offer because it's quote-unquote too cheap.
It's a massive flex.
It is. It completely flips the script. It shifts the whole narrative from this, legacy company slowly fading away to a company drawing a strict line in the sand regarding its intrinsic value.
Which brings us to the core of what we do here. This is Market Pulse Daily, where we break down the latest price action, the underlying catalysts, and the real market sentiment behind the stocks that are moving today.
Exactly.
And if you're joining us and this kind of analysis helps you cut through all that daily market noise, make sure to subscribe, hit the like button, and drop a comment below with the next stock you want us to cover.
And before we really get into the mechanics of why that $60 offer got rejected, we should probably mention how you can actually dig into these numbers yourself.
Oh, yeah, for sure.
Because if you want a faster way to research the companies behind today's moves, you should explore StockOracle. We have a special 14-day trial link down in the description for you.
It's such a great tool. It's an AI-aided stock research web application, and it basically pulls everything you need into one platform.
Yeah.
I'm talking fundamentals, valuation estimates, AI moat analysis, bull and bear insights.
The comparisons, too.
Yes, stock comparisons, plus your standard watch lists and portfolio research tools.
It saves a massive amount of time when you're, trying to figure out if a rumor actually aligns with a company's real balance sheet.
Right.
But we always want to be completely transparent about the tools we use. So StockOracle is built for research. It is definitely not financial advice, and it is not a recommendation to buy or sell anything.
It's also not a trading signal service, and it doesn't provide real-time market data. You have to remember that AI insights and those valuation estimates, it spits out, well, they can be incomplete.
Or just flat out wrong sometimes.
Exactly. The data might be delayed. You always have to verify the important facts yourself and make your own decisions based on your own risk tolerance. Also, just so you know, that link in the description is an affiliate link. That means the channel might earn a commission if you use it, but it comes at absolutely no extra cost to you.
Having a solid research foundation is really the only way to survive in this market. And when we look at PayPal's foundation, the numbers actually start to explain that rejected buyout offer.
Yeah, let's transition from the flashy buyout rumor to the actual business engine, because the very first question you have to ask yourself is, why would a major competitor like Stripe even want to buy them?
Right. Why take on that baggage?
Exactly. And if PayPal stock has been struggling for the better part of a year, what does the board see that makes $60.50 look cheap?
You really have to separate the stock price from the business performance here. I mean, despite the brutal macroeconomic headwinds, the inflation fears, the consumer spending crunches we keep hearing about, the actual business is showing serious resilience.
Yeah.
If you look at their trailing 12-month data, revenue growth is sitting at roughly 5.79%.
Which, let's be honest, is not the hyper-growth software numbers people got used to a few years ago.
No, not at all.
But it's solid. It's moving in the right direction.
It's very durable. And what matters a lot more is how much of that revenue actually makes it to the bottom line. They are pulling in a very healthy $5.34 in trailing earnings per share.
Wow. Okay, so not a cash-burning startup.
Far from it. The operational efficiency here is staggering, really. They are maintaining a gross margin of roughly 41% and a net margin of 15%.
Okay, wait. I want to pause on that 15% net margin. Because that is exactly where the disconnect happens for me.
How so?
Well, I look at this situation, and it reminds me of owning a highly profitable luxury estate, right?
Yeah.
Generates massive cash flow, the foundation is rock solid, the rent is always paid on time.
Right.
But it happens to be sitting in a neighborhood that has just temporarily fallen out of favor. The street signs are faded, the neighbors are moving out, and suddenly a buyer walks up and lowballs you. They offer a price that barely covers the cost of the marble in your kitchen.
I love that analogy.
So you shut the door. You wait for the market to realize what your house is actually worth. But my pushback here is this. If they are generating massive free cash flow and they have that 15% net margin, why is the broader market treating them like a dying legacy tech company?
It's a fair question.
I mean, their market cap is sitting around $49.5 billion, but their price-to-earnings ratio is depressed at just 9.8. Are we just staring at a classic value trap here?
The value trap question is literally the most important one to ask right now. Because a PE of 9.8 for a tech company, well, that usually implies the market thinks earnings are about to fall off a cliff.
Right. The market thinks it's over.
Yeah. But to understand why the market is terrified, while Stripe is apparently hungry, you have to look at the mechanics of their competitive moat. PayPal's primary advantage is its two-sided network effect.
Okay, unpack how that actually functions for the listener, because, network effect gets thrown around a lot as just a buzzword.
It really does. Okay, so in digital payments, you usually have companies that focus on the merchant, giving them the software to accept credit cards. Or you have companies that focus entirely on the consumer, like giving them a digital wallet.
Right, usually one or the other.
Exactly. But PayPal has both. They have hundreds of millions of active consumer accounts on one side and then millions of merchant relationships globally on the other. And they manage this through platforms like Braintree and Venmo.
Oh, right.
Because they sit on both sides of that transaction, the switching costs are incredibly high. I mean, a merchant doesn't want to drop PayPal because millions of shoppers specifically look for that button at checkout.
But competitors are absolutely attacking that moat. We can't pretend they aren't.
Oh, they are. Specifically in what we call unbranded processing.
Okay, what is that exactly?
This is the back-end payment plumbing. It's when you, as a consumer, enter your credit card on a website and you never actually see the PayPal logo. Stripe and other competitors have been aggressively eating into that specific space. It's becoming heavily commoditized.
So it's basically a race to the bottom on fees.
Precisely. The margins on unbranded processing are getting squeezed hard. But PayPal's management saw this happening. They haven't just been sitting there. They've aggressively pivoted to focus on their high-margin branded checkout volume.
Meaning the literal PayPal button you click to bypass typing in all your credit card details.
Yes, exactly that. That branded button commands a massive premium in the industry. And why? Because of trust and conversion rates. Consumers feel secure clicking it, which means merchants get fewer abandoned shopping carts.
That makes total sense.
So while their overall unbranded volume growth might be slowing down, prioritizing the branded side is what protects that 15% net margin we talked about.
Okay, so bringing this back to the buyout rumor. The board rejecting that $60.50 offer makes a lot more sense now. By publicly calling it inadequate, they are essentially establishing a fundamental valuation floor for the stock.
Yes, they are drawing a line.
They are telling Wall Street, hey, we know our cash flow, we know the premium our branded checkout commands, and we aren't selling this profit engine at a single-digit multiple.
It signals extreme confidence in their standalone turnaround plan, but words from a board only go so far. What really validates that confidence is how the money is moving. We have to look at how the insiders are actually playing this.
Oh, let's definitely get into the market sentiment, because the price action tells a very specific story right now. Over the past year, the stock is down about 28%.
It's been rough.
Yeah, the 52-week high was near $80, but it's currently trading much closer to its 52-week low of roughly $38.
Right, and that 28% drop reflects the macro pressure and the multiple compression we just talked about. The market punished them heavily for those unbranded market share losses.
But wait, if you shrink your timeline and look at just the last 13 weeks, the return is actually up over 9.5%.
Exactly, almost a 10% gain in a quarter.
That indicates a nascent bottoming process to me. It's testing support right around this $55 level. And momentum is definitely heating up too. The 10-day average volume is trading at 1.5 times the 3-month average.
The institutional positioning is shifting for sure, but you hit on the most compelling data point a second ago, the insider buying.
Oh yeah, this is huge.
When executives and board members use their own personal capital to buy shares in the open market, They only do it for one reason. They think the stock is going up.
Yeah, they aren't doing it for charity. And over the last 90 days, corporate insiders have acquired a net of nearly 889,000 shares,
Almost 1 million shares.
accumulated by the exact people who actually see the internal dashboard every single morning.
To put a metric on it, the managerial sentiment proxy rating, which tracks this kind of insider behavior, is sitting at a heavily bullish 64.47.
That's high.
Very high. I mean, you have the buy transactions heavily outweighing the sell side right now.
I love it when the narrative and the data line up perfectly like this. You have a board publicly rejecting a buyout offer because they claim it's too cheap. Simultaneously, those same insiders are aggressively scooping up hundreds of thousands of shares with their own money.
Putting their money where their mouth is.
Exactly. They are practically screaming to the market that the $56 share price is totally disconnected from the intrinsic value of the company.
And they are buying against the backdrop of a massive structural shift in the digital payment space. We really have to look at the macro environment for enterprise settlement to see the full runway here.
Okay, what kind of shift are we talking about?
Real-time settlement. Recent industry surveys show that 76% of Treasury professionals consider 2047 real-time settlement to be a crucial priority for their business.
Meaning they want their money instantly.
Instantly. Not in 3 to 5 business days. But here's the catch. Only 19% of them have actually achieved it.
Wait, 76% want it, but only 19% have it?
Uh-huh.
That is a staggering gap. You have massive demand for liquidity, and the traditional banking plumbing just can't deliver it.
Exactly. The traditional SWIFT networks and, standard banking hours create so much friction. But an integrated platform like PayPal, which manages its own internal ledger across millions of merchants and consumers, well, they can bypass a lot of that friction.
Well, what do you see?
If they can capture that enterprise value and close that gap, it adds a massive new growth vector to their existing branded checkout moat.
Man, the setup here sounds incredibly asymmetric. The M&A chatter is swirling, insiders are accumulating shares, and the momentum is turning positive.
It's compelling.
But look, we cannot just look at the upside. We have to debate the pros and the cons, especially because there is a massive binary event looming over this stock literally tomorrow morning.
Oh yeah, tomorrow morning changes everything. PayPal is scheduled to report their Q2 earnings.
Right, so let's structure this for the listener. The bull case is fairly straightforward at this point. You are looking at a cash printing machine trading at a historically depressed PE of 9.8.
Yep.
You have massive asymmetric upside driven by insider accumulation and a clear structural floor set by the board rejecting that $60.50 buyout bid.
Yeah.
You are basically buying a highly profitable luxury estate at a steep discount right before a potential turnaround.
The fundamental floor seems really secure, assuming the business metrics hold steady tomorrow.
Right, but I'm looking at tomorrow's earnings call, and honestly, it feels like walking a tightrope without a net for anyone holding this stock right now.
It's definitely risky.
I mean, if tomorrow's earnings show that they're actually losing market share in their core branded checkout, does that $60 buyout floor suddenly just crack? Does the board's confidence even matter if the math proves them wrong?
That is the ultimate operational risk, and it really forms the core of the bear case. Wall Street analysts are going to zero in on 2 very specific metrics tomorrow: branded checkout volume growth and margin stability within Braintree.
So if there is even a hint of deceleration there, the market is just going to punish them.
Severely. Any guidance cut or any sign that consumers are clicking the PayPal button less often instantly validates the market's worst fears.
It's the proof the bears are waiting for.
Exactly. It would prove that the bearish thesis is correct, that PayPal isn't just suffering from temporary macro headwinds, but is permanently losing its crown to competitors.
But does the low valuation offer any protection there? I mean, a 9.8 multiple means expectations are already scraping the bottom of the barrel. Hasn't the market already priced in the slow growth?
It has priced in slow growth. It has not priced in structural decay.
Right.
If the earnings show that the foundation is actually crumbling rather than just settling, the market will absolutely re-rate the stock even lower. You could see that multiple compress to 7 or 8.
Yikes. And we also have to factor in the M&A disappointment risk. Let's not forget that a good chunk of this recent 9.5% rally over the last 13 weeks is built on the speculative premium of this Stripe and Advent rumor.
Right. The rumor mill is doing heavy lifting.
What happens if those talks collapse entirely?
That is the most acute near-term risk outside of tomorrow's earnings. Speculative premiums vanish overnight. I mean, if the deal falls through or if Stripe walks away because they see something in the books they don't like, that premium unwinds violently.
It's a total rug pull.
Yeah, the stock would likely retrace those recent gains and test those 52-week lows of $38 again very quickly.
It is a true binary catalyst. We have earnings tomorrow, the resolution of these buyout discussions looming in the near term, and broader macro tensions, inflation data, shifting interest rate expectations, all playing a role.
A perfect storm of variables.
Though I will say, if the broader market shifts into a risk-on rotation, beaten down fintech names with low multiples like PayPal could see disproportionate inflows.
It's a clash between incredibly strong cash generation and deeply negative market perception, and it's all coming to a head in the next 24 to 48 hours.
Let's summarize the ultimate setup for you as you watch the market today. PayPal is a highly profitable, cash-generating machine. It is trading at a historically depressed multiple of 9.8 times earnings. They are maintaining a 15% net margin and solid revenue growth despite a brutal environment.
And leadership is signaling immense confidence. Insiders have aggressively accumulated nearly 889,000 shares in the last 90 days.
That's huge.
Plus, the board rejected a buyout offer that sits roughly 8% higher than the current trading price. They clearly believe the intrinsic value is much higher.
But you are heading into a massive binary week. Tomorrow's Q2 earnings call is critical, and the looming M&A resolution with Stripe and Advent could swing this stock wildly in either direction.
The key risks are very, very real. If the M&A deal falls through, or if tomorrow's earnings disappoint by showing a deceleration in branded checkout volume, the downside risk to this recent rally is severe.
It's a high-stakes moment for one of the original pioneers of the internet economy, that's for sure. Now, if you want to dig deeper into the financials behind today's move, remember you can check out StockOracle using the special 14-day trial link below in our description.
Highly recommend it.
It's a great platform to review fundamentals, valuation estimates, AI moat analysis, and compare PayPal directly against its peers.
And as a final reminder, because we have to say it, StockOracle is a research tool, not financial advice.
Yeah.
AI insights and valuation estimates can be incomplete or wrong, and the data may be delayed.
Always double-check.
Always verify the facts yourself and make your own trading decisions. The link below is an affiliate link, which means the channel may earn a commission, but at no extra cost to you.
Make sure you subscribe for more fast market updates and drop a comment below telling us which stock you want us to break down next.
The market always has another puzzle to solve.
Always does. I want to leave you with one final thought to mull over, something outside the immediate earnings and M&A drama.
Oh, let's hear it.
Everyone is hyper-focused on PayPal as a traditional payment processor. But think about the sheer infrastructure they own. They have hundreds of millions of verified, regulatory-compliant digital wallets sitting in consumers' pockets worldwide.
That's a massive network.
Exactly. If central banks eventually roll out central bank digital currencies, a digital dollar or a digital euro, the government does not have the retail infrastructure to distribute it to the masses. They need a bridge. They need an existing, trusted network.
Oh, I didn't even think about that.
What if PayPal's ultimate endgame isn't fighting over a few basis points of transaction fees with Stripe? What if their real intrinsic value is becoming the primary distribution node for the future of sovereign digital currency? That kind of infrastructure is practically priceless. Keep that in mind as you watch the numbers tomorrow. Until next time, keep digging.